Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back live with the latest episode of Carson's Facts versus Feelings. Ryan and Sonu here as always. Sonu, we have I guess a couple birthdays in the house, but we're going to start with the bull market. We're titling this week, The Bull Market Turns 2. Two years ago was that terrible bear market. But you mentioned your twins, and you said they turned 10. Then you quickly corrected yourself. They turned 8. But what were the birthdays
10.
This week? Yeah.
That birthday is on Thursday, October 10th. So
Okay.
10/10, 2016. The same, about 20 days before the Cubs won the World Series. And we were right next to Wrigley Field at the time. So that's my memory of, I blocked everything else out, right? The crazy hours and things like that. Like, oh, the Cubs won. So
Right.
That's funny. But you have a few birthdays too, right? October is a big month in your family.
Yeah, it's something else. My one son just had a birthday in September, Gus, and Sebastian has his 14th birthday, October 21st. I have an anniversary on October 14th, so please remind me, Sonu, if I forget that.
How long? How many years?
Oh my goodness. I guess it's like 18. 18.
Wow.
18. Yeah.
Wow.
Well, because we just had like our 20.
Congratulations.
Yeah, we just had like our 20 years of meeting. So we went on a little trip for that recently. But yeah, so it's kind of, okay, whatever, 18. But my birthday is October 28th. So call us birthday season. There's a lot.
Okay.
Then my daughter's birthday is early November and my wife's birthday is early December. And then, of course, you have the holidays. So it's
all
happening.
happening.
A lot. It's all happening. It's a lot. But we're gonna get into it. There's a lot to talk about. Again, we're going to focus on the bull market turning 2, kind of why we still think it's a bull market. Maybe a little bit about October volatility would be perfectly normal. Talk about that. Then last week had some strong payrolls, right? The employment backdrop continues to be strong. Maybe talk a little services as well, which is strong. And then finish it up with how much time we have. And you've got kind of a hard stop here in about 30 minutes with some election stuff. But let's start, obviously, get serious for a minute with the terrible hurricane that's already gone through. And by the time a lot of people hear this, obviously Milton, it looks like it's heading straight again for the Tampa, Sarasota area. So our thoughts and prayers just go out to everyone who's clearly been impacted by one hurricane already, and unfortunately another one. Now, Sonu, feel free and jump in there.
No, absolutely. I mean, we actually have quite a few people we know. I mean, professionally, I mean, between, I think, Ned Davis Research, those folks around there.
Yeah.
The folks from ARC are in St. Petersburg as well. Is it?
Yeah.
I'm a little
true.
unfamiliar with the geography there, but I think St. Petersburg, Tampa is right around the same area, right?
Yes, it's right there. Mm-hmm.
Wow.
Just south of Tampa.
Stay safe, everyone. I mean, that's all,
Yeah, Raymond James is right there as well. Obviously, just so many people. And then it looks like, I mean, again, we're doing this on Tuesday morning, but potentially it's going to go right across the coast, right across Florida, and maybe right through Orlando as well. So we'll just see. And obviously, again, thinking of so many people I've mentioned before on this very podcast, I think, how my family, when we used to live in Charlotte, used to go up to the mountains, what we called it, which is like the Boone Blowing Rock area, about 2 hours from Charlotte. A lot of people go up there and hang out. And it's just a gorgeous part of the world. One of my favorite places in the world, to be honest. And obviously they were just decimated last week or two weeks, week and a half ago. But obviously they hopefully build back and continue. Mm-hmm. I guess, the thing, Burt White, our CEO, he's got a property up kind of that part of the world. It was impacted as well. He did a thing on Twitter and you can see it. But Bert said, the best way to support that part of the world is obviously we can donate where we can donate. But the other is as soon as they get back up and running, like get back there and support them and go back. And I can't wait to get back up to Boone and Blowing Rock and support a part of the country that I'm a big fan of. But again, we'll just kind of
make it out there once that's done. I've never made it out to North Carolina, actually, or South Carolina for that.
Well, so I lived in South Carolina just about 4 miles maybe or so into the border from North Carolina. So we did a lot in North Carolina,
Wow.
obviously. So those states are very close to my heart, North Carolina specifically. So again, in Asheville, I mean, I love it. We went to Asheville just in May for a little
I thought you
weekend trip.
did. Yeah.
Yeah, we were in
Wow.
Mars Hill, just a little bit north of Asheville, maybe by a half hour or so. Got a nice Airbnb, stayed at this gorgeous house, and part of me is wondering, I wonder how that house is doing right now. I don't know, but it
Wow.
was a great part of the country. So go back and support it when we can, and obviously everyone is going to be impacted by Milton that's coming through. We're thinking of you. So no easy transition here, Sonu, but it's our job to go forward. So let's talk about this. The bull market 2 years ago right now. We're in the midst of, and then we had the 1 year anniversary of obviously October 7th. So
Yes.
those thoughts go there as well. With the devastation that had and all the war and all the deaths and so many terrible things that have happened the past year since then. Yet a funny thing happened when it comes to markets. We've continued to rally, right? We've continued to rally in this bull market 2 years ago, right about now. October 12th is when that vicious bear market from early January of 22 to October 12th of 22. And one more final thing, I'll turn it over to you. On October 12th of 22, let's hit rewind for a minute if you want. That morning, we had a CPI report. Remember when CPI prints actually used to cause market volatility? It's nice they don't anymore. That's inflation data, everybody. We had inflation data. It was worse than expected. Market sold off hard. It was down like 2% or so near the open. Then a funny thing happened. Close the day up over 2%. I did a study when you hit a 52-week low, and I'm going off memory here, but when you hit a 52-week low, down 2%, and then close up 2%, very, very rare. I went on Yahoo Finance that day and talked about why we just might have hit the low. I think they looked at me like I had four eyes. And sure enough, here we are. So when you get those extremes in selling, just everything feels terrible. Believe me, we were optimistic there's going to be some type of low in October of a midterm year. We said that repeatedly, and then you come in that morning on that CPI print. It didn't feel good, but we saw that reversal. So no, I could keep going on, but talk to me about the last 2 years. What surprised you? Why we're here? What do you want to go? Where do you want to go with this?
I literally have that chart of yours where stocks tend to go higher even with bad news, right? And that's I don't know if you remember that one, like all the way back from 1900. The Panic of 1906, World War I, the Great Depression, World War II, Korean War, Vietnam War, JFK assassinated, Arab oil embargo, Iranian Revolution, SNL crisis, GFC, COVID-19. This feels like a Billy Joel song.
Yes, it does.
But the blue line just keeps going up. I mean, yes, you get volatility in between. What surprised me over the last 2 years, that so many people missed what I feel was sort of right in front of them, right? and I we'll talk about payrolls, but I feel like, and maybe it's a function of like, we've talked about this, right? People focusing on your classic indicators that did the job over the last several cycles, M2, PMIs, yield curve inversion. None of it works, but you always have to think, why did it work the last time? And then you get to why it didn't work this time. I think it comes down to the fact that, this cycle has been, the economy is doing well, and I will say well as opposed to okay right now, because we're banging out 3% GDP growth numbers quarter after quarter. So it's well. It's not just okay anymore, right? The economy is doing well. Why are we doing that? Because it's driven by income growth as opposed to credit growth. I think that and that was clear. I think looking at the data, and especially 2 years ago, inflation had started to come off the boil. Oil prices are coming down. We were talking about real incomes. I mean, our good friend Neil Dutta was also talking about real incomes. Nobody else was talking about that at the time. And I felt like, wait, it's right there. It's not like we had secret data or anything, right?
Well said. I mean, for whatever reason, people tend to gravitate to the negative, and we've been pushing. We called this podcast "Facts versus Feelings" for a reason. Feelings matter. There's no question.
Totally,
we're dealing with people's livelihoods and their retirements and college funds and savings and all that stuff. But facts matter more, I think, at the end of the day. And again, it's that delicate line. But one way to put this. So a year ago, right now, and you and I had this conversation on this very podcast, we could probably go back and find it about 52 podcasts ago. The bottom line is what I noted at the time. This year one of the bull market. So again, from October 12th of 2022 to a year ago, was up, S&P up about 22%. All right. That was like the weakest first year ever. All right. And I remember everyone said how weak it was, Yeah, and everyone said how bad it was going to be. And I looked at it and said, listen, if we don't go into recession, and Sonu's telling me we're not, so I trust what Sonu says here, there's a lot of other reasons I think we play catch up in a big way. Fast forward, Sonu, we've gained over 30. Again, by the time the final numbers are out, we're up over 30%. All right.
Wow.
We're up over 30% year 2 of this bull market. What I said back then, we looked at 16 prior bear markets or near bear markets. And after that, year 1 was higher every time, or once it got to year 1. Once it got to year 1, that's 16 times. Year 2 was higher. You ready for this? 16 times. All right. Every single time. It made it to year 2. So this shouldn't be a surprise at all. We got to year 2. Now, here's where it gets interesting. This is, again, technically the second birthday, but now we're starting year 3. Will we be in a bull market 1 year from now? In other words, making more new highs 1 year from now? We think we will be. But to put some color around this, 4 out of those 16 bull markets did die year 3. They stopped going up and eventually went into a bear market. So that happens. So about 75% of the time, that's about your average year. The average return, okay, looking at those 12 that made it, okay, you were up on the year, 9 of them, so about 75% of the time, up about 8% on average, median return about 12% average. I just gave a lot of numbers there, but the bottom line, this bull market indeed can make it to the 3rd year, and double-digit returns 1 year from now, I don't think are that abnormal. In fact, it's probably possible if the economy continues to surprise the upside. I'll be quiet here, Sonu, but what other thoughts do you have along those lines, or different lines you want to go?
I'm smiling here because I'm like, that's our outlook, 2025, people.
Yeah.
Look, the bull market is, another thing, the bull market's young. There's some ways to go. It's not over. Now, one thing I'll add, I mean, like connecting the economy to markets, right? What's that connection? I always think it's profits.
Yeah.
Right? Clearest, easiest connection, hopefully at least easiest. But a lot of this is being driven by profit growth. You go all the way back to 2019, December 31st to 2019. All the way through the end of the 3rd quarter, so just a few days back, 8 days back from when we are recording this, the S&P 500 is up 92%. 92%. That's just shy of 5 years, even if the market's flat for the next 3 months, right? Which we don't think it will be. But out of that, earnings growth, profit growth, contributed 57 percentage points, right? Dividends contributed another 14 percentage points. So you're talking about 71 out of 92% came from fundamentals, profit growth, and companies returning profits in the form of dividends to investors. Valuations, that feelings part of it, right? And you expect valuations to go up in a bull market. I mean, valuations are not going to go down in a bull market. As people feel more optimistic, yeah, what do you expect? I mean, valuations are going to go up, but we just don't want things to get that stretched. And it wasn't, right? Valuations contributed 21 percentage points. So fundamentals basically made up more than 75% of the total return over the last 5 years, or 5 years minus 1 quarter. So I think, all that to say, this is not a bubble. The bull market is young. We have some ways to go, and things look pretty solid.
I was going to joke, so it's not a bubble. I know you've been pushing back against it with record earnings growth, record profits, improving profit margins, strong productivity, all the stuff we've been talking about for what feels like 2 years now is there. Now, a couple other things. I just pulled up some data. Looking again at those 16 instances of bull markets that took place after bear markets, year 1 is up 38% on average. All right, that makes sense, right? The first year after a bear market, you usually get a big snapback. Again, this prior 1 year, this bull market win was up 22.4%.
And that's why everyone is like, oh, this is actually not a bull market.
Exactly. Saying it was not a bull market. And I pointed out, I remember doing this the 1 year after the 87 crash. Okay, so that bear market 1 year later, S&P up only, I'm going to use air quotes, I'm not, but both hands are full, but I would use air quotes right now, only 21%. I said it back then. Year 2 that time was up 29%, so it made up a lot. This time again up about 32.5%. Okay, during year 2. Year 2 averages right around 15% on average, so we had a better year 2, and then again it's 7.8%, so we'll call it 8% average during the 3rd year of a bull market, which is about your average year, which after those big gains, it makes sense. A little more, Sonu, then maybe we'll go forward. Again, looking at all the bull markets going back to 1950, I've got the data here. This one's up 61%. Okay, this one, since, again, over the 2 year, up 61%. Your average bull market and I think there's 11 of them here. 11 of them
Okay.
up 180% on average.
Wow.
Median 108. That is skewed by a 582% rally from December of 87 all the way until the peak in March of 2000, because we never had a 20% correction that full time, and a 400% rally from March 9th, 2009 to right before COVID, a 400% rally. Now, the other way to look at this, okay, so we, hey, maybe we got some more to the upside. It's all about duration also. The average bull market, looking at all these bull markets again since 1950, 5.5 years. This one is turning 2 this weekend. Median of 5. Yeah, happy birthday. So just
in more ways than one.
Yeah, and then one just fun little trivia stat for you. 5 out of the 12 now started in October. So we talked about this 2 years ago, saying it's normal to see a bear market end in October. It's normal to see midterm years be pretty darn rough, but bottom in October. Real strong fourth quarter of a midterm year. We said this stuff 2 years ago. People thought we were crazy for saying it. Here we are, and it's playing out, fairly nicely. So the bottom line, I guess, again, this is still a young bull market. I know that upsets people. It makes people mad to hear that. It's still a young bull market. Doesn't mean it has to roar another 33% the next 12 months. We don't think it will. We're not going to complain. We don't think it will. But upside, low double digits, it's still very possible. Sonu, I mean, we've gone a while on this. What else you want to say on this front?
I was going to ask you the same question. What surprised you? And this is triggered by, we had an event recently, you were there too, where our founder, Ron Carson, said, one thing that surprised him this year is how strong the markets have been. And part of me is thinking, like, wait, we've been pretty bullish. Right?
I know, I was thinking this, yeah. Eddie, listen to us.
I love Ron. So, well, if you're listening to that, let's Ron, shout out to you.
Right.
But no, so I saw a stat of yours, which you just mentioned to our partners the other day. 2024, goodness, I almost mistake my years. I almost said 2025. 2024, first 9 months, strongest year we've seen for an election year, right? How surprised are you about that?
Yeah, that is a tad surprising, because I think I was anticipated most of the strength by the latter half of the year when it comes to this bull market. But again, I forget who said it, but we've all probably said it to a degree. I think Jeff Sott, big fan of Jeff. I think he said it before. But surprises in bull markets happen to the upside. So I mean, we're in a bull market. We shouldn't be surprised when surprises to a bull market happen to the upside. It's not rocket science. They tend to go higher. We've been above the 200-day moving average for a very long time. Very simplistic way to look at it. The 200-day moving average is pointing higher. That's a bull market, and we're still in one. But again, the big moves and big rally, no, I don't think it's a surprise. We said before, when you have a president up for re-election, and I get it, asterisk, the president chose not to run again, but the previous 10 times, stock market's higher. You know what? When you have a split Congress, the previous 13 times, stock market's higher. We knew this stuff coming in. We knew that once a bull market makes it to year one, and not all of them do, that is what it is. When a bull market makes year one, it's never not made it to the second birthday. We knew this stuff. We talked about it repeatedly. Again, anything can happen, and it doesn't mean it has to happen. When you stack all this stuff on, you and I talk on this podcast 45 minutes a week, every single week, or at least 50 weeks a year, talking about these things, it isn't that surprising. And I think one thing that surprised a lot of people, last comment here, gold is hitting like all-time highs. I don't think we're quite there right now, but for the most part it has. We talked before, well, we have a little bit of gold. We have a little bit of gold in some of our tactical models out of that March of 23, okay? And I looked at it kind of like a play on bonds, not necessarily stock. Look at that other part of the portfolio is supposed to help you if stocks don't work, if our bullish call doesn't work. And boy, gold is really outperformed bonds. So we should have added more looking back. But hey, you can't get them all right. But I think that surprises a lot of people is gold hitting new highs and stocks hitting new highs. I know 18 months ago, I said something along the lines of, you can have both in a bull market. We've seen it before, right? I mean, what's the old quote in the movie Major League? It's called a winning streak. It's happened before. It's happened before where for years, both of them can go higher and both can make new highs. It doesn't mean we're about to just fall off the abyss and the end is near, because gold's at new highs. And here we are, and it's been happening. So fortunately, it's been another nice call by our team in general. Anything else you want to add there, Sonu?
No, I think I've been thinking about the fact that all this has been surprising. That's not a bad thing, because that means people are probably on the more pessimistic side. Yeah. Here's a feelings part of facts versus feelings, right? Yeah. People are more on the, I don't think we're in a bull market. Well, good. The surprises, there will be surprises and surprises to the upside going by what you just said. So
Yeah.
that's a good thing, right? When everything's not skewed to one side.
Well said. I remember being on with Judge Scott Wapner on Closing Bell on CNBC. It's probably April or May or so of 23. And I gave the bullish, what we'd see. I gave a bullish outlook. And he's like, well, yeah, what's your biggest worry, though? What's your biggest worry? You gave me all the reason to be bullish. And he was skeptical, I could tell. And I said, my biggest worry, I just winged it. People say it's TV plan. No, it's not. I don't even know what I'm going to say. I just look up and watch it. So, oh, God, I said that. Anyway, but
I believe that.
Yeah. And I say, I wing it. And I just said, my biggest worry, I think I probably said, our biggest worry is people are not open to the idea this bull market has a lot of life left. They're not open to the idea the economy is going to be stronger. They're not, allocated properly to this move that we're going to see the upside. Yeah. And I don't know, whatever. He got out of the interview, and looking back, it's like that was probably the right way to look at it. Now, again, we have more worries and things now. We get into that kind of with the election and things,
but there's always worries, right?
There's always worries. I mean, hey, it's October. October is the worst month of the year in an election year. When you're up 20% for the year heading into October has only been higher, I think, 2 out of 9 times, up down like 3% on average. When you're up over 30% year over year going into October, once again, October's down a great majority of the time, down about 4% on average. I'm not saying this is like a major worry. I just think people need to realize that we're up, Sonu, 10 out of 11 months. We're up 5 months in a row on the S&P. Best start to an election year ever. I mean, things been great. Don't get me wrong, but maybe we have some little volatility here in October. One more final stat. I can go all day on this stuff, and usually we do. When the S&P gains 5 months in a row, like it just did, 1 year, that's happened 29 times. 1 year later, the S&P is higher 28 times. And I forget the exact return. It's like low double digits. It's not a wildly bullish 1 year return, but it's saying consistency. It's saying low double digit returns a year from now, which is ballpark kind of what we think could happen here, is very, very so above average returns.
Yeah,
I mean, average year is like 8.5%. So above average returns, but likely higher. When you're up 5 in a row, you're still higher a year later, 28 out of 29 times. I mean,
that's a good thing to keep in mind, right? Yes, the average return is 8.5%, 9%, something like that. But as you pointed out, and this is my favorite chart of yours, I think Sam Rowe and Blake Mile, shout out to them. They were talking about this at Future Proof, by the way.
Right.
I think it's their favorite chart as well. No year is ever the average, right? Which means then if you're in a bull market, odds are you're going to get a double-digit return. It's very simple.
It is. I mean, your average year gains 19% when it's higher for the S&P, and it's 14% when it's down. Okay, these big swings are more normal. You look at history, 21 times the stock market's gained 20 or more percent on the year, 21 times been down on the year. Your odds of a 20% gain are the same as a negative year. That blows people's minds, but it is true. And who knows, maybe we're going to gain 20% this year, so you have a higher chance of a 20% gain than a down year. Pretty fascinating stuff, but pretty fun stuff. So all right, so Sonu, that was a great. Anything else? I think we kind of covered that. I don't know.
Yes. We'll come back to it, I'm pretty sure.
And if people could only see, like, literally, we're like, what do you want to talk about? I don't know. Do we have enough to talk about? I don't know. Maybe, So, no, I did see. So, again, we're recording this on, what is today? October 8th. October 8th, 2024. Again, episode 104. The bull market turns 2 of Facts versus Feelings. The Great Chicago Fire was 153 years ago today, apparently. Wow. You obviously live in Chicago. I've heard about the Great Chicago Fire. I'm hitting you with this. You didn't know this was coming. But how devastating was that fire? I mean,
I think it cleaned large parts of the city. I mean, obviously the city's smaller then. Yeah. But what came out of that is probably more interesting, because then we got, Chicago's sort of coming out party was the 1870s World's Fair. I forget the exact year. I should know. You would think I know. But there's a famous book about that. I mean, tangential to Devil in the White City. I'm sure several readers have read it, but I'd highly recommend that. But yeah, the World's Fair was Chicago's coming out party, and that, what you see modern Chicago right now when you come in, especially in the summer, and you enjoy the city. I do think it's the best summer city in the world, not just the US, in the world. I've been to several cities. Nothing beats Chicago, to be honest, and including food and things like that, right? Oh, yeah. But yeah, no, that after the fires, so much of it is, it was all rebuilt in a big way. And that's, it's probably, when you think about 20th century architecture and skyscrapers, things like that, Chicago became sort of like a proving ground for a lot of architects. right? This is where they said, we're going to, this is where we're going to make our name, right? And that's why you walk around Chicago, you see so many interesting buildings, and everything's along the river. So it
Right.
was almost showing off, but at the same time paying homage to other architects that came before them as well, right? So even modern buildings, there's some reflection of what came before, as well as all the new stuff, the steel and glass and things like that. So I think the fire was interesting because it literally cleaned everything out except for water tower. There's that one stone structure, because it was built out of stone. It's the only one that stood, right? And of course, this is just a myth. It's not real. Like Mrs. O'Leary's cow, and was the
Oh,
Mrs. O'Leary's cow, I think, was the
yeah.
one that supposedly started the fire. No, that's debunked.
Ah.
It's a myth. It's still a nice one.
Yeah, that's all right. Okay. Yeah, I mean, I just, again, with all the devastation that's happening in our country right now with the hurricanes, obviously with too much rain, right? That's the issue. We've had too much rain and terrible flooding. They said that the Chicago fire started because something like 41 or 42 days before there wasn't a lick of rain, right?
Yeah.
It was just super duper hot, super duper dry, and then the cow kicked something over and started the whole thing. But anyway, so
but
yeah,
again, that's a story of resilience and rebuilding. That's pretty much a story of America too. And you see that in the stock market. We started with that, right? We talked about all these different geopolitical events. There's always something to worry about. I joke that if you're a global macro strategist, you're never positive. You're always pessimistic because there's always some monster under the bed, right? But the line keeps going up and to the right.
No, you're right. I mean, hey, it's October now, right? It's the spooky month, the scary month, and there's always some monster under the bed potentially. But all in all, if there's a little bit of a monster, we still think we're in a bull market. Let me take one more second here, Sonu, then let's talk about the payrolls. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback, and that helps us there. The more reviews, that helps the algorithm with these podcasts and Google and everything else. All right, Sonu. So Friday was the payrolls number.
Yeah.
We've been seeing some weakening payrolls a little bit. Concern was there. It came in stronger than expected. I forget the exact number, but like 250-ish versus 150. I know you've got it. What was your take on payrolls there?
Boom. That's it.
There we go. Okay, that's good. Yeah.
Just plain and simple. Boom. Now, look, we came into this payroll report, and there were valid concerns. That wasn't like, oh, people are just being bearish for the sake of bearish. I mean, that group is always bearish, so ignore that, right?
Sure.
But there were valid concerns. We've talked to a few of them, like Guy Berger over at Burning Glass Institute and things like that. There were reasons to be worried. I mean, it doesn't mean things are falling off a cliff, but the trend was not good because the trend was going, most trends are going down. Namely the unemployment rate, right? A year ago, the unemployment rate was about 3.5%. It had gone all the way up to 4.2, 4.3%. By July, a couple of months ago, it hit 4.3%. And so, and then you look at the JOLTS data, right? Job opening and labor turnover survey. Hiring is basically back to where it was in 2013, 2014. Again, now net number of jobs created was still positive. That's because layoffs are low, right? That's been the one sort of positive and really positive story amongst all these labor market, a lot of different labor market downtrends we've seen recently, is layoffs are still low, right? So, and initial claims for unemployment benefits, that's been really low as well. So all of that is nothing pointing to what we'd normally see in a recession. So, but then the downtrend's concerning, and this report sort of, and that's part of the reason the Fed was also concerned, right? They went 50 basis points. If we didn't see I'll put it this way. If the unemployment rate in July and August was 4%, I don't think we would have gotten a 50 basis point cut. But because it went up to 4.3%, I think that's why we got the 50 basis points. That really like stoked a fire, behind whatever. Like, okay, we need to get, we need to get to the program here. The good part is that because they cut 50 basis points and the labor market data for September payroll data was as strong as it was, I think we can sort of comfortably say they're not really behind the curve. And that's good. Pretty unique as far as the Fed is concerned, to say that the Fed's not behind the curve. I think that's positive, right? But getting into the data, before I'll get into the data, what do you think about the data and market reaction of it?
Yeah, I mean, Friday was a big day for the stock market. A big rally, small caps, mid caps led, so the market liked it. I guess what got me was I believe Neil Dutta, Mac pointed this out on his podcast. Great podcast. I forget the exact name of it, but check out Mac's podcast. He noted that August has now been revised higher 9 of the last 10 months. So we have big revision. We had a good headline number 254 versus ballpark 140, 150. But the 2 previous months were revised higher. So that's a nice little change. I haven't seen that in a while. And you mentioned the unemployment rate. It came in at 4.1, but it actually came in at 4.05%. Yeah, from 4.22%. So we were really, really close to a 4.0, which probably that's familiar for you. You always got 4.0s. I was more of a 3.4 type of guy. I always had fun. I did enough to get by. I just talked a lot, It still works, man. 22 decades in, I just talk a lot and it's still working. Still get my 3.4, but getting through things. But almost at a 4.0 on the unemployment rate, which would have been obviously, I think, surprising for a lot of people. Because just a couple months ago, the SOM indicator, we talked about it. We're huge fans of Claudia. We've had Claudia on this very podcast, and we didn't have her on our show, but she's out in the media saying, well, maybe it's different this time. Don't get too worked up.
My own indicator with a grain of salt. Right?
Yeah, because again, the size of the labor market's growing. There are more people trying to get a job. Maybe it's a little increasing for some other reasons. Anyway, those are some. And earnings. Earnings came in stronger than expected. So we're making more money again. You talked about that, incomes and wages, and all that stuff. So that's a good thing. Oh, by the way, the Fed is cutting. Maybe not going to cut 50 now. Maybe they cut 25 the next couple of meetings. But it's still Tom Lee, big fan of Tom. Obviously, Tom's like, hey, listen, the bottom line, whatever the Fed's going to do, they're going to do 50, 25, 75, whatever it is. They're not doing 75, but I just threw that number out there. But the reality is they're now cutting. This is now a dovish phase for at least the intermediate time being. Let's not get too, let's not make this too confusing. That is a tailwind for equities here. Go ahead, Sonu. What else you want to add there?
No, I think, look, the headline number itself, payrolls growing by 254,000. Mm-hmm. Expectations were for 125. So twice that, right? More than twice that. And it's better than it actually looks because we got upward revisions. Remember, everyone is like, the negative revisions and things like that. August and July revised up by 72,000. I mean, these things can be revised. Take the 3-month average. It's 186,000. Before the pandemic, 2019, the average was 166,000 jobs a month versus 186 between July, August, and September, right? And even the industry mix, and people, again, there's so many things knocking, like, it's all healthcare, it's all government. And out of the 254,000 jobs created, 136,000 of them.
So hopefully it's more than 136.
Yes.
I'm teasing.
136,000 of them was cyclical sectors, leisure and hospitality. Construction was positive 25,000, right?
Right.
Professional and business services, retail, right? I think there was one disappointing piece, which is manufacturing, but that's where I think hopefully Fed rate cuts would, start to make that go up, basically. Then he talked about earnings. Average hourly earnings is running around 4.4 to 4.5% thereabouts. Annualized pace last 3 months. That's strong. That's quite strong, but it's not red hot. It shouldn't be anything that worries the inflationistas at the Fed. It's like, oh my God, wage growth is too high. We need to stop cutting. No, not that, right? But at the same time, remember what I said at the beginning of this episode.
I have absolutely no idea. I don't remember.
There you go. I'll remind you.
Yeah.
But look, this cycle's all about income growth, right? And if you think about aggregate income growth across all workers in the economy, it's a product of employment growth. That's solid. Wage growth. That's, as I said, that's strong. Hours worked. That's slightly flat to negative, right? But aggregate incomes are running at 4.5% annualized pace over the last 3 months. That's basically nominal GDP growth. That's pretty strong. That's stronger than the trend we saw over the last cycle. And remember, inflation's fairly low. I know inflation looks like it's 2.5% or something, but that's because of shelter. You ignore that. I think underlying inflation, honestly, is probably running close to 2%, if not even slightly lower right now. And remember, I mentioned hours worked, right? We just got those big GDP, GDI revisions. I think we talked about that. GDI, gross domestic income, actually looks better than GDP right now, if you go back over the last 5 years. But productivity growth is a big part of it. So what do we get? Output is revised up. Hours worked is flat to slightly negative. that means we are creating more output per hour, right? So
Mhm.
that's productivity. I think that's another big story people have missed over the cycle.
Yep.
Productivity. They still kind of, I think, believe that productivity growth is running strong. I think a lot of people, I don't want to say excuses. I think there are valid concerns like, oh, this seems too good to last. But I
Right.
think there are, valid reasons why productivity growth is a good
Well,
story right now.
Well, I mean, congrats to you. I mean, you've been talking about higher productivity in our country lasting longer. We've had a quarter or two of high productivity before. You said,
Right.
no, this is going to stick around for a while. And here we are, multiple quarters
Yeah.
into that. I know we're almost top of the hour, Sonu, so we probably need to wrap it up.
I got a few
One of,
minutes.
Okay. Well, hey, I can stay all day. This is more for you. But I did one other thing I want to point out. Bloomberg has a survey of economists, I think like 65 ballpark economists. The most optimistic out of every single Bloomberg economist surveyed for the jobs number was 220,000. Okay, it came in at
Wow.
254, so that was better than even the most optimistic out of like 60 something people. The other thing I wanted to point out: only two out of these 60 some economists expected the unemployment rate to go to 4.1%. All right.
Wow.
So once again, what's the
Talk
old
about
joke?
upside surprises.
I mean, economists have predicted 15 of the last two recessions, whatever phrase you want to use there. I know this makes sense with the weather, man. I got a weatherman joke, but with everything on the weather, I'm not going to go there. Anyway, but no, the reality is the economists continue to kind of be missing, I guess, the upside to the economy. A lot of strategists miss the upside to the equity markets, and we don't think that's going to change anytime soon. All right, so I mean, what do you want to talk about? We were going to do the election. I think we're going to have to push that to next week, which is good. Maybe that we can really focus on the election fully next week in next week's podcast. Tons of stuff to talk about there. Yes. And who knows, 7 days from now, who knows what's going to be new with the election. But what are you watching this week? I guess we have PPI, CPI. What else should we be paying attention to?
CPI, I think inflation being low. I think inflation, we've talked about it being last year's story, last year's problem. As long as inflation remains low, I think the Fed can focus on protecting the labor market gains. And that's an important piece of, we wrote about this in the Outlook about close to a year ago now, that productivity, there is an AI story and all of that, but I think that's coming down the pipe, right? It's not yet, that's not what's driving productivity gains right now. What's driving productivity gains right now is, I think, a strong labor market. And that's why it's so important that the Fed protects that. And I think they're doing that, right? I think, but what allows them to do it is low inflation. And that's why I think CPI is still sort of, it's not as big a deal as it was, maybe 2 years ago. When that CPI report came out on October 12th. But it's still there. That's part of the Fed's mandate, right? And but every month we're going to see some upside surprises and things like that. But the big picture is, look, inflation is last year's problem. And even the payroll report, actually, the one that just came out, the September payroll report, is probably the last payroll report that is going to be quote unquote clean, right? Because the next one is going to be impacted by everything that's happening, unfortunately, in North Carolina, Hurricane Helene, things like that. So we're probably going to get, see an adverse impact of those hurricanes on October payrolls. And then fingers crossed, that's all going to come back in November. So it's going, and the November payroll is what we're going to see in first week of December. So it's actually going to be 2025 before we get a quote unquote clean payroll report again. So I think that's why the September payroll report took on like outsized influence. It's funny, over the weekend, I was sitting waiting for my kids, some activity to end. I think my son's karate class or something. So I was just sitting around. Okay. Obviously on Twitter, people are like, you can't believe the economic data, the government skewing it. This is all gaslighting. It's like, look, okay, fine. Don't believe the economic data. Believe markets, right? Look at profits, right? Look at returns, right? Returns are being driven by profits. Profits wouldn't be rising to this extent if the economy was weak. It's really as simple as that.
So I heard Spirit Halloween, right? Those little pop-up stores that come out, and around this time of year, I heard this morning the Spirit Halloween is going to start doing Spirit Christmas or Spirit Holiday season. So instead of so they're going to own these stores they rent instead of just for a month or two, for like 3 or 4 months. So again, would they be doing that if they didn't think Christmas and holiday shoppers would come out? Probably not. And again, I get it. I think President Biden was asked this by a reporter just the other day. How can we trust this jobs number that we just revised 800,000 jobs, just recently, and we get it. Those headlines are out there, and we've talked a lot about jobs and things. I mean, the employment backdrop is still improving and solid. Is a perfect no, but like you pointed out, profits are still strong. Go to any airport, go to any restaurant. I mean, they're all still crowded. There's still people out doing things. Maybe people are being a little more cautious. I'll tell you, I'm a little more cautious right now. I got like 19 birthdays and holiday season, and I'm trying to be a little more cautious right now. But nonetheless, all in all, it's still pretty good. And
I'm
you mentioned the word
a big party for my kids this weekend. So,
what are you guys doing? What are you doing?
It's one of those places. I think it's like this kids play thing.
Yeah,
They're calling, I don't know, a couple of 24 of their friends.
Okay, but it's not at your. So you're paying for it not to be at your house, is what you're saying.
Oh, it's not at my house. Last year we did it at my house, and
that's a terrible idea.
I'm not doing it again. No.
Yeah, we've been there, done that. We Gus's birthday was somewhere else. Sebastian wants to go bowling with some friends, late night bowling. So yes, that sounds. I think they're going to come back into a sleepover, but we'll just stick them in the basement and whatever. They can destroy the basement later. Yeah, I don't know. We'll see. We'll see.
I'm looking forward to them getting older, where maybe they don't invite 25 kids to their birthday parties, and they're inviting only 5 or 6. Right?
Mm-hmm. Yeah.
Now it just seems like, and my kid, they're both in different classes, so we couldn't invite 50 people. Yeah, so the nice thing is they're both at the same time, so that helps. But still, it does mean a larger party. And last year, bad idea to do it at home.
I hear you there. I guess finally, you mentioned we're driving a little bit ago. I mentioned on the podcast 2 weeks ago I hit a deer. Poor guy. Don't
Is
know
your
where
car
he went.
okay?
Well, I don't know. That's my update. I still am driving around the rental car. I'm in no hurry. I actually had to go to the body shop last week because there were some things in my car when I dropped the car I just didn't think I'd need, but I did because it's been in the body shop for almost 2 weeks now. So anyway, hopefully soon enough my car will show up. But I have like the exact same car, just a different color. So hopefully the car shows up.
I'm going to be on the market for a new car next year. So by the way, I wonder what's a good time to buy a car. Maybe
I don't know. Let's ask
people
the listeners.
Can email us.
Let us know.
What's a good time to buy a car? I'm going to be in the market for a new car next year sometime.
Facts versus feelings versus his VS. Facts versus feelings at carsongroup.com. Let us know when Sonu should buy a car or what car he should potentially buy. That'd be good. But Sonu,
I know new vehicle prices are going down even further, so that's going to be a positive tailwind for CPI. So. That's why I'm still waiting.
Yes, they're going to time the new car purchase. That's very you. I like it though. So, all right, everybody, we're probably going to wrap this one up. This again was episode 104, Carson's Facts versus Feelings. The bull market turns 2. We'll be back next week, obviously, with episode 105, and I think we're going to focus a lot on the election next week. We had a lot of material, but as usual, Sonu and I just start talking, and a bunch comes out. But we're going to save all the election talk for next week, and it'll be a fun discussion. All right, everyone. Enjoy the bull market. Sonu, good luck getting ready for those birthdays. We'll see everybody next time. Thank you. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.